Hi, I'm Max Keiser. This is the Keiser Report, and this is central bank monetary policy. Yeah, get it! Take it! Take some! Yeah! 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 Stacy?
More money, they might call it. It is so much money, M-O-A-R, money, more money. And you know what, Max? Now, some people say all that money printing is going to cause inflation and it devalues everybody else's currency, but they're offering us a bargain here. US Treasury expects to borrow $2.999 trillion in net marketable debt in April to June quarter, $3.055 trillion more than estimated in February.
$2.9 trillion. Come on down to the Fed's bargain basement. $2.9 trillion. Order now and get $6 trillion more in 6 months. Order now, get $6 trillion more in 6 months. Come on down to the Fed bargain basement. Hi, I'm Jay Powell. I print money like a maniac. Come on down to the Fed's bargain basement. We'll give you $1 trillion right now. You got some old baseball cards. You got some old silverware. You got some old rags sitting around the house. We'll give you $1 billion. Come on down to the Fed's money printing shop right now.
You know, you might want to... This is Christine Lagarde's money printing. Go brrr.
Oh, Christine Lagarde?
Yes.
Hello. Je suis Christine Lagarde. And voilà mon machine de imprimer l'argent. Regarde bien. Oula, 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 oula. Oula, c'est ça, c'est beau, c'est magnifique. Oui, Christine Lagarde. Oui. Venez dans mon maison avec beaucoup de trillions d'euros, Christine. Argent, cassette, argent, coucou.
Okay. We know that your French is not up to par, but we're going to, hey, I have 100 euros right on my jacket, my velvet jacket. I'm feeling flush. Unprecedented. The U.S. expects to borrow a massive U.S. dollar, $3 trillion or 14% of nominal GDP during the second quarter alone. Current outstanding public debt is now $25 trillion. I think we're about halfway there in this room.
Keiser Report never fails to deliver the goods. You know, we've been saying now for a few years that ultimately they're going to $100 trillion. Japan's already at 100% debt to GDP on their Fed's balance sheet. Kuroda, their central banker, has already taken their central bank above 100% of GDP in terms of debt. That's buying a lot of junk, a lot of assets. So America at $6, $7, $8, $9 trillion. They've got another $60 trillion to go. The globe is set to go to 100% GDP debt to on the balance sheets of the central banks. So, you know, there's $100 trillion to go. There's stock markets are booming in particular sectors, it's particularly in the banking sector. Remember the PPP program from the feds. It all went to JP Morgan first. They took their cut, which was substantial, like 20% or more. And then whatever was left over, they doled out to the poor serfs and peasants in America. Here, voila. It's like, you know, papal indulgences. We'll give you $10 if you give us $50 in banking fees, says Jamie Dimon. I'm the Pope of bad money. I'm the Pope of fiat, Jamie Dimon. My God, what a crook.
Well, you know, they continue to print. Apparently, the U.S. deficit, the budget deficit, will hit $4 trillion this year. I remember the shock only just recently in the last few years here on Keiser Report of when the U.S. budget deficit hit $1 trillion. And we were like, oh, my God, like this is the end. But apparently, it's going to go to $4 trillion. That's why they're borrowing $3 trillion. But they're saying all of this infinite fiat is going to cause infinity war because let's look at this. Central banks' pandemic battle could stretch into an infinity war. Big central banks are buying from an expanding menu of government bonds, corporate debt, and consumer loans to help businesses and households through the coronavirus pandemic, and no one knows whether it can stop.
Right. Well, again, I was dead right in that the central banks are taking the entire economy private, right? They print the money to buy all the income-producing assets, to buy all the stocks, all the bonds, all the property, all the leases, all the mortgages, everything, right? So they're taking the entire economy private. I've mentioned that first as a concept maybe 3 years ago here on Keiser Report. Now you have news reports from mainstream media saying, oh my God, what if they never stop? What if they just keep buying everything with all their printed money? What would that mean? So there's two possible outcomes. Number one is neo-feudalism, where you have a return to the Middle Ages and all of the economy is owned by a few oligarchs and everyone else are living on, peasant indentured servant click farms, like click on the ads on the social media to try to win a protein pill. The other outcome would be pure Sovietization of the economy, where the state owns everything and everyone is equally poor. That would be the other outcome. So, but either one of those two are where we're headed, and or a combination of both. So that would be the worst of both possible situations, a pure kakistocracy. But one thing that's not coming back is free market American capitalism.
Well, Plucky's coming back because he loves money printing. Remember last episode, we wrote him off. We said the days of fiat are over. This is their Hail Mary, all this money printing going on. He is, of course, British. That's why he's so spindly like this. But he's got to print some pounds here.
Plucky, go, Plucky, go!
That's for the Queen. That's for the Queen.
The Queen is financially incontinent. She needs her adult diapers.
Well, in the extreme case that a recurring virus requires further damaging lockdowns, the U.S. Federal Reserve and its peers float the whole boat: government debt, corporate debt, perhaps even financing for mortgages and paychecks. Of course, Max, we're going to need a bigger boat, right? That's the old saying out in Jaws land where, the black hole of debt is... Oh! Well, I should actually put Plucky.
Wait a minute. You're saying Plucky's British because that machine toy was loaded with pounds. That's not right. Plucky is a red, white, and blue American chicken.
No, that would be a big plump one. We bought this in when we were in the United Kingdom, but you know what? So here they're talking about the Infinity War because, of course, all fiat is measured just against other fiat. So if they're all collapsing and they're all spreading around in a big pile of junk on our, studio floor here, well, there's no way to tell which one is more devalued than the other. They're all devaluing against each other, but it's also caused a great deal of, strife for the American population. Not only have we had to export all our jobs in order to export dollars to maintain our reserve currency status, but the Fed constantly has to intervene for the whole entire world when these crises happen, because every time a crisis happens, the dollar goes up, and therefore all the other economies in the world suffer because there's a shortage of dollars, and time out of work erodes skills, business failures destroy wealth and depress investment. Cheap money and cash transfers risk fueling asset bubbles that widen the gap between rich and poor, as we've talked about, the Cantillon effect and the rise of the cantillionaire class.
Yeah, that's right, the cantillionaire class, people who just shake down the Fed like Warren Buffett. But even that has limitations. Like Fed really denied Warren Buffett. He was trying to shake down the airline industry during the crisis of the past couple of months and get sweetheart deals and freebies and guaranteed profits. And the Fed stepped in and said, no, we're going to be buying airline shares in front of Warren Buffett. They front run Warren Buffett, the ultimate front runner. To give you an idea, because the Fed is now much bigger than Berkshire Hathaway. It's much bigger than any of these private equity groups. And the purpose is to take everything private for the people who own the Federal Reserve Bank of America, which are about 20 or 25 families, and that's it.
So importantly, with a cantillionaire class and with a Cantillon effect, what happens as, basically Bastiat would have warned you about, this corruption spreads, right? The corrupt class consolidates its wealth and basically feeds each other the free money. And one thing I was told in confidence, so I can't give the source, but in the past week, somebody has told me that they used to work basically with somebody within the New York Fed. And anytime there was a crisis like this, i.e. the government was about to tell airlines that they couldn't fly at all and they were going to shut down all airline flights, normally what would happen is how they get around the insider trading is they're saying, we're calling, we're the New York Fed and we're calling the experts. We're going to call all the experts out there like that just because we want to help you, the ordinary people who are not cantillionaires. So we're going to call Warren Buffett and say, hey, Warren, we know you own 10% of the big 4 airline stocks in America. What would you think if we had to shut down all flights? i.e. they're signaling to him this is coming. They're not giving him inside information. They're saying they're just asking this benevolent ukulele playing guy to give some free advice to the ordinary people.
Right. If you do a forensic analysis of Buffett deals over the past 30 years, you'll find a similar quid pro quo in virtually all of them. It's all inside information. Inside information is the hardest crime to prosecute of all major crimes. And their way to get around it are almost infinite. And that what you just described is just one way to get around insider trading law. And Buffett, though, is having trouble because he helped fuel the rise of this monster, the Fed, and now it's attacking him. It's like the Frankenstein. You know, the movie Frankenstein is about the mad scientist, Dr. Frankenstein. The monster had no name. So Dr. Frankenstein, Warren Buffett, created the monster, created the Fed, this nameless money-printing rogue contraption that is putting everyone out of business, and nobody can stop it.
But also in the last days of empire, as we've cataloged here and chronicled here on Keiser Report for the last 10 years, you do get hyper-partisanship, and we're having hyper-partisanship. And Warren Buffett is a well-known Democrat, and he sponsors Democrats. He clearly doesn't like Trump, and therefore he's not getting those calls. Steve Mnuchin is not calling Warren Buffett to say, hey, what would happen if we shut down the airlines? Clearly, Warren Buffett, who is the ultimate insider, the fiat, infinite fiat insider, he had no idea this was coming because remember, before he dumped all his shares, he bought more Delta shares, 1 million on February 27th. So he clearly was not given any warning about this.
Okay, that's something that we need to dig into a little bit because you're saying in this case, due to political partisanship, he was not tipped as he always has been or usually is. And this would make sense then in retrospect because he dumped those airline shares like a petulant child.
Yes.
He had just bought Delta, 1 million Delta, a couple of weeks before at an all-time high, I might add. And then suddenly, because he wasn't tipped on the inside information, he became a brat and said, well, I don't care. I'm just going to blow it all out. And I don't care who's hurt, the hardworking men and women of America, to hell with them. He said on his conference call he still believes in America while he stabbed in the back America. And now he's losing horribly and his reputation is trashed.
And finally, Max, it gets to the question, at what point are we worried with just how much a role the Fed is playing? Said Catherine Judge, a Columbia Law School professor who studies financial markets, if they are the only actor and people are worried about liquidity and access to finance, how much pressure comes to bear? Longer term, it is disconcerting.
Right. How much? Where do they end? They're not going to stop. As we've been saying in the Keiser Report for years, they will not stop until every last stock and bond and piece of property in America and other places around the world is bought by this private consortium of bankers called the Federal Reserve Bank, and we are then into neo-feudal times mixed with a little Sovietization to give it some nice flavor. Well, we're going to take a break. And when we come back, myself and Plucky and Stacy won't be here. It'll just be me and a guest. Don't go away. Welcome back to the Keiser Report. I'm Max Keiser. Time now to speak with Lawrence Lepard. He is over there at the Equity Management Associates. You can follow him on Twitter. I follow him on Twitter. He's got lots and lots of really good stuff to find out all about his words on hard money, wisdom, etc. Lawrence, welcome to the Keiser Report.
Oh, thank you, Max. Honor to be with you guys. I've followed Max and Stacy for years, and as I said before, you guys are the OGs of sound money. So I'm honored to be with you.
Oh, cool. Wow. All righty. Let's get into it. So, Lawrence, you write in your latest newsletter, the Rubicon has been crossed and the U.S. government goes direct with helicopter money. Elaborate on this. What is helicopter money in this case and what happens from here?
Sure. As I'm sure a lot of your listeners know, I mean, in 2008, they started increasing credit and printing money, and we all thought hyperinflation would follow, and we were wrong, and some of us suffered as a result of that. What they did was they really plugged the hole that had been created by the collapse of the debt structure in the housing market, but the money didn't make it to the people. The money made it into the stock and bond markets, and so we created a bubble there, and velocity fell, and so you didn't, although inflation is understated, as we all know, you didn't really see the inflation that we expected in that particular cycle. And the reason is the money didn't really get to the people. And in this particular case, that certainly has changed. I found it fascinating that, pre the COVID crash, the notion of printing money or giving money to people or being running large deficits was somewhat anathema to so many people. And Andrew Yang and Bernie Sanders were considered nut jobs. And of course, the minute the stock market that the 1% own is threatened with illiquidity and a crash, and you see all the the risk arb guys going out of business, they certainly figured out a way to get money to the people. And so, although the checks are a pittance, the direct money sent to corporations and all the money that they're using and printing and distributing, that represents the helicopter money that Friedman talked about so many years ago, and then that Bernanke irresponsibly signaled was a possibility going forward. And we're there. And of course, once you start that, you can never stop. And everybody listening to this already knows that. And so it will only grow. And as my good friend Dan Oliver says, this time we're going to get inflation, good and hard. It's coming. And even to the degree that we get short-term deflation in something like the price of oil, it doesn't really matter, because I would submit, and this is counter to Lacey Hunt's argument that falling velocity is going to protect the money. I would submit that what's going on really here is what I call CSIP, which is currency substitution inflation. And people are going to start to see that the dollar is no good. I mean, if you look at the United States government, you look at their deficits, you look at the balance sheet, you realize that it's just completely bankrupt. This government is beyond bankrupt. And so as a result of that, it's just a matter of time until people wake up and they realize that having savings that are dollar denominated, whether they be in cash or bonds, it's just going to be a very bad place to be. And all it's going to take is a breakout of the gold price from something north of 1,700 to 1,900, which is the old high, and then into the 2,000, 3,000 range. And then Gresham's law will take over, in my view. And, we'll be on our road to what I sadly think is a Weimar-like outcome. I hope they're smart enough to maybe try a restructuring before that. But looking at the politicians that we have in office today, I can't with good conscience say that's a high likelihood event. So sorry, that's a long answer, Max, but I wanted to kind of set the stage.
Right. Well done. So we're going to get into this money velocity number and chart in a moment, but I just wanted to go back to what you were saying there in terms of the expectation in 2008 with all the money printing would be inflation. We didn't have that inflation. We actually had more deflation. And looking back now, it does make sense that we would have more deflation, because looking at the big picture, Lawrence, starting in 1971, when the U.S. closed the gold window and we went into a global fiat currency land where all money is issued without backing. And so it can be said that all fiat money is debt money. It's all brought into existence as debt. And so if, in fact, the debt money, which does have an interest rate attached to it, floods the economy, and then the need to pay interest on that debt means you have to issue more debt money to pay off the existing debt money, well, then you're going to have a situation of perpetual deflation, because you're flooding the economy with debt, and debt results in deflation when the debt can't be paid, when you have a debt default. The U.S. defaulted on its economy, on its notes, on its obligations in 1971. And they replaced gold with fiat money nonsense. And now that default, 45 years later, and after going through the crisis of 2008, has metastasized into the crisis of 2020, which is 10 to 50 times bigger. So what I want to get into here is all the terms being used, inflation versus deflation, and these two terms are defined differently by different camps out in the economic study. However, one chart and one graph and one data point has been resolute in depicting what's really going on, and that would be the money velocity chart, which I think has really given us a clear picture of what's happening. Can you tell us what the money velocity chart is and what it's telling us?
Sure. It's a function of how much money is moving through the system, and it's been going down consistently. And Lacey Hunt was very early in depicting this and understanding what it implied. And, I like James Turk's view of it. I mean, money velocity falling, actually, if you look at hyperinflations in the past, the velocity is falling because there's just so damn much money out there that you don't need that. You don't need a lot of velocity to keep the economy where it is. And so what you've really done is you've shoved more fake money into the system, and there are deflationary forces going on. And we had other deflationary things happening too. I mean, China and the China price and internet and technology and so forth. And so as a result, it's been somewhat masked. But as you pointed out, different people view inflation and deflation in different ways. I mean, I think in consumer prices, we're going to have a mixture of both. I mean, I know, for example, we have a lot of inflation in the price of eggs in my town. They're up 300%. But we've got a lot of deflation in the price of gasoline. And so, that's, to me, not what's really relevant in this picture here for all of us as investors. I think that the relevant area to look at is the asset area. And that's where I got to my CSIP thought, which is laid out in my Q1 report, which is that, where are you going to put your savings? I mean, assuming you really have savings, many people don't. Certainly the government doesn't have any. But to the degree that you have savings, you have legitimate assets, where do you want them to be? Where would they best treated on a going forward basis? And I would submit strongly, and I know the two of you agree, that the precious metals and Bitcoin are really the two obvious places you want to be.
All right, let me jump in for a second, Lawrence, because I want to follow up on what comment you made there, that the money velocity shows that too much money is in the system. So let's unpack that for a second, because we did establish that we're talking about debt. And debt is not the same thing as money. Money is only really gold or Bitcoin. When you have a fiat currency that's debt-based, and you have a flood of that into the economy, then we see the money velocity go down. If this were actual money, if the fiat, if the currency, if the dollar were backed by gold, there would be a natural competition to own the gold, to own the money, and people would work to accumulate more money, more gold, and they would be entrepreneurial, and banks would lend to businesses, and that money would end up in the system being lent out to new businesses, and money velocity would go up because people are competing for gold backed or money backed by gold. But because it's only paper that's backed by nothing, and the way to get it is to petition the bank to get a bailout, and they print it for nothing and it's worth nothing, then you get this money velocity collapse because there's no competition anymore in America. It's all about positioning yourself in Washington and proximity to the Fed to get the free paper nonsense money. And that's what the money velocity shows. Now, to your point about gold bullion, the gold bullion is making new all-time highs in every major currency in the world by leaps and bounds, by huge, huge amounts, except the US dollar. Because the US dollar is world reserve currency, and it has particular attributes that prevent it from hitting new all-time highs today. But you believe it will be hitting new all-time highs in US dollar terms soon, and could be heading in between the $6,000 to $20,000 per ounce level. Based on what exactly, Lawrence? Can you dig into that for us?
Absolutely, Max. I mean, what's going on here is there's a very tight relationship between the federal budget deficit and the growth in the gold price. And in my report, which I'm sending out for free, you can see that Meridian Macro has done a very nice job of capturing that. And what you see is that the federal deficit last year was about $1 trillion. This year, at a run rate, it's running at about $6 trillion. So there's a $5 trillion increase. And the price of gold goes up $500 for every 500 billion, or $1,000 for every trillion of budget deficit. So basically what this math says, if this correlation holds, is that the price of gold is going to go up by $5,000 as this deficit unfolds. So that would imply $6,700 gold price, basis today's price. And, I think it's likely to happen.
And historically, looking at the charts, if you overlay debt over gold price going back 40 years, they always go together, except for the last few years where they've done an amazing job at breaking that relationship. But it looks like that relationship's coming back, which would imply 6,000 plus per ounce of gold.
Yes, absolutely. And I think the reason they were able to break the relationship is they started another credit cycle. and they've been extremely effective at using tools. We all know what they are, to create paper gold and suppress the gold price, which they know is the canary in the coal mine to the system they're running.
Cool. Now, how do people get in touch with your newsletter, Lawrence? Are you giving away copies, I hear?
Yeah, copies of the newsletter are free, just because I want more people on this side of the trade. It's my email address is Lepard, so LLEPARD @EMA2, EdwardMarkAlpha2.com. Send me an email. I'll put you on the list. Every quarter I write something explaining how I'm viewing the situation. Talks about gold stocks, etc.
Yeah, and Bitcoin too, because as we know, Bitcoin is gold. Thanks for being on the Keiser Report.
Thank you very much, Max. Thanks, Stacy.
Sure, that's going to do it for this edition of the Keiser Report. With me, Max Keiser, and Stacy Herbert. I want to thank our guest, Lawrence Lepard. You can find him on Twitter. You can find us on Twitter, the Keiser Report. Till next time. Bye, y'all.